Hi, my name is Holly Penuel. I'm the owner of Camp and Craft, an event planning, marketing, and consulting business. This is the fourth video in a series of videos where I've partnered with ventures to tell you more about some important business concepts. Today, we're putting it all together in a P&L or profit and loss projection. If you're not sure what an operating expense is or cost of goods sold, then I recommend you go back to the previous videos and check those out before proceeding. Otherwise, let's get started with estimating our expenses and revenue and putting it all together in a profit and loss equation projection. By the end of the day today, you should understand the profit and loss equation, be able to explain factors to consider when estimating monthly operating expenses, understand ways to project monthly revenue or sales, and you should be able to apply terms learned in previous videos to calculate estimated net income or net loss using the profit and loss equation. In a previous video, we learned about the profit and loss equation. Basically, revenue or money earned minus expenses or money spent equals our net profit or our net loss. We can use the profit and loss equation to project or forecast net profit or net loss for our business. There are several factors that we should consider when estimating our monthly expenses. First, we should make sure we understand the difference between fixed costs or variable costs. Fixed costs stay the same from month to month, while variable costs change depending on certain factors. These are things like utilities, which vary depending on how much is used, labor, which depends on the hours worked by employees, marketing, that's up to the business owner to decide how much to spend, and taxes will depend on things like income, sales, wages, and more. Just a quick side note, it's important to consult a tax professional to learn more about estimating taxes for your business. We also want to consider expenses that can occur quarterly or annually, such as taxes or license renewals. Let's look at the estimated monthly expenses for an example business. In this case, I've started an artisan jam business making jams from my home and selling them at farmers markets. I started this business in August, so I have some startup expenses included in my projections there, and I've projected my expenses through the end of the year. Let's take a look at our estimated expenses line by line. First, we have license and permits. These are the things we had to file in order to start our business. So we only have them in August, the month that we started our business. Next is insurance. It's a fixed cost, so it's going to be the same month to month, $75. After that is marketing, specifically Facebook ads. I've decided as a business owner what I'd like to spend each month on marketing for Facebook ads. And you can see that I decided in November to spend a little bit more in preparation for the holiday season. Next is marketing for signage and print. Once again, I'm spending more in August when I start my business so I can have things like signs for my booth at the farmer markets. Followed by supplies, again, spending a little bit more as we start our business. These are things like paper, pens, ink for printers, etc. And then leveling that cost out for the remainder of the year. Next is farmer market fees. This is where I plan to sell my artisan jams. I've estimated that each farmer's market will cost me about $150 to attend. So I've estimated that I plan to do 3 in August, 1 in September, 1 in October, 3 again in November, and 2 farmer markets in December. This is the main way that I plan to sell my artisan jams. This is a great example of a variable cost because the cost varies depending on the number of farmer markets that I attend. And then finally, in September, I have estimated taxes. For the purposes of this video, I used an online calculator to determine what I think my estimated taxes will be. But like we said in a previous slide, it's really important that you talk to a tax professional to learn more about what you think your tax expenses will be. And finally, along the bottom, we have our total estimated expenses for each month. Next, let's take a look at our estimated monthly revenue. History is a really valuable indicator on what you can expect to make moving forward. We can always look at previous months or the same month last year to determine what we think we will make in the upcoming months. If you're a new business, you may not have much data to go off of, which is why it's a recommendation to look at industry data or industry associations. They're usually really great about compiling data for you to use to inform your revenue expectations. If we're a new business, we might be starting out with just a couple of clients, so it makes sense to budget for reasonable growth. What is your goal? How many clients do you expect to have, or how much money do you want to make? And what does it take to get to that point? How many clients or how much more money do you need to make every month in order to get there? You also want to consider special events or promotions or certain times of year. So if you are a retail business, you might expect to make more money in the months leading up to the holiday season. Let's go back to my example business, the Artisan Jam Company. So I've decided in August that I'm going to do 3 farmers markets, and I've estimated that I can sell 50 jars of jam at each market. So in August, I'm doing 3 farmers markets. That's 150 jars of jam total, times the $15 sale price for a jar of jam means that I will make $2,250 in August at farmers markets. I'm also launching my online store. And since it's just getting started, I think I'm only going to sell 10 jars of jam in the month of August. So that means $150 in revenue in August for online sales. So in this example, we're estimating how much jam we think we will sell based on the number of farmer markets we are attending and by how much growth we expect to have in online sales through the end of the year. Once we've estimated our revenue, we must subtract out our COGS, or cost of goods sold. We've calculated that each jar of jam costs $3.78 to produce. So if we take our sales, our expected revenue for each month, that estimated 160 jars of jam in August, and multiply it by that $3.78 per jar of jam to produce, we get $604.80. That means it costs $604.80 to produce those 160 jars of jam that we expect to sell in the month of August. And we do that same calculation each month based on what we think we will sell during that month. Finally, at the bottom line, we have our gross profit. We take our total revenue, subtract out cost of goods sold to give us our gross profit. Now that we've calculated gross profit and our total estimated monthly expenses, we can consider our net profit or our net loss. Simply, we take the gross profit, subtract out estimated expenses to get our net profit or loss. We can see that we operate at a profit in August, October, November, and December, and that we operate at a loss in September. Remember that it's from the net profit that we take our owner's draw. So what does that mean for the owner in the month of September? Well, that means that I'm not making any money in September. I'm not going to be able to take a draw. Now, if this is a side hustle, that might be okay, especially since I expect to make a lot more money during the holiday season in November and December. If your business will be your sole form of income, then operating at a loss might not be an option. So you'll have to adjust your expenses and your revenue and decide if that's feasible or not. And that's it. Let's take a moment to review. When estimating monthly expenses, it's important to differentiate between fixed costs and variable costs. Fixed costs are more predictable as they stay the same from month to month. Variable costs differ depending on certain factors and include expenses like utilities, wages, and more. And it's also important to plan for expenses that occur quarterly or annually. When estimating monthly revenue, historical data is a valuable indicator for projected revenue. And after estimating expenses and revenue, we can use the profit and loss equation to predict how much money we think we will make or lose over a period of time. Thank you so much for watching. To learn more, visit online at venturesnonprofit.org.